Hello, folks. Brandon Chapman with you today. It's another edition of the TheoTrade video for Monday, September 16th. The title of today's session is the train leaving the station, destination unknown. We're talking Fed policy. And we can apply that to the markets as well. Again, what is the destination? Where is the market going? Where is the Fed going? And we marry the two. Again, where is the market going in light of Fed policy? The Fed is about to lower rates for the first time in over 4 years this week. And boy, it's a bit of a doozy. If we come in here, let's take a look at the CME Fed Watch tool. This is for the end of next year, for example. Let's go to September and we'll look at the September 18th meeting. We're talking about a 65% probability of a 50 basis point. That's a 0.5% cut in the Fed funds rate. Well, just a month ago, we're pricing in 25%. Just a week ago, we were pricing in 30%. We are escalating towards a 50 base or 0.5% cut from 5.25% to 5.5% to 4.75% to 5%. You'll see the indication here. As we look at November next. November, we're looking at a 80% probability of a quarter point cut. That's 4.5 to 4.75% or less. An 80%, so a quarter point cut in the November meeting. And then we look at December. Well, December right now, look at 4% to 3.75%, about a 63% probability. What does that mean? There's a 63% probability the Fed will cut 1.25 to 1.5% by December. It's 20% chance they cut 1.5%. What's going on here? Why the sudden rush? We've talked about jobs, for example, certainly indicating recessionary type pressures. Is the Fed saying we expect inflation? Expect recession? And they certainly have never called recession in the past. Why would they start now other than their policy may reflect such a thing? If we look at the current Fed holdings right now, the Fed, actually, let's bring up IRX first. If we look at IRX, this is 3-month T-bills. This is basically indicating what Fed policy's done. And you'll see right now, if the Fed is cutting 50 basis points, that's 5.25 to 5.5% up here. We cut 50. Now we're down to 4.75 to 5%. Right now, the 3-month T-bills are pricing in less than 4.75%. The T-bill market's already priced in those 50 basis points and more. We're pricing the probabilities of cutting in November and December. We've seen a huge bid here, and this is something we've talked about. I've shared in my sessions since June, is looking at SHI. If the Fed's going to cut rates, well, guess what? SHI should do pretty good. This is 1 to 3 year treasuries. Could SHI get back up to 86 if the Fed goes to ZERP? Yes, they can, right? We're currently seeing a nice little run here. What's the prospect for long-term treasury bonds? We've got a bid under here under TLT. We're at 3.6% on the 30-year treasury yield. Where's this going? Well, if the Fed goes to ZERP, could we go to 170? Absolutely. Right? The Fed goes to by next year. Well, let's see what it is. So let's look at the expected Fed funds rate for next year. So we'll go out here to December of 2025. What are we pricing in right now? We're pricing in a 2.75 to 3% Fed funds rate. At greater than what? At greater than like a close to 70% probability of doing that. And again, that's a what? A 1.5% to 1.5% cut. Sorry, is that right? 2.5% cut by next year. This is pretty crazy when you start to think about this, right? 1.5% by the end of the year, 2.5% by next year. Again, what is the hurry? If the Fed cuts rates, what are they jeopardizing inflation? The potential that inflation could be much, much higher next year? Unless what? They're expecting inflation is going to calm down because of why? Because we're entering recession. If we look at the current holdings of the Federal Reserve, right now they're holding about $3.7 trillion in notes and bonds. They're holding about $2.2 trillion in agency mortgage-backed securities, for total sum of holdings of $6.5 trillion. Their balance sheet's over $7 trillion. They've actually recently increased it. Why? I mean, you come back here and you look at, for example, what the Fed has done from a policy standpoint. Let's go back to IRX, CGI. You look at their policies and you're like, why did they raise rates the fastest pace in history? Why didn't they reduce the size of their balance sheet before they raised rates like this? Why didn't they take down their reverse repo operation? Why did they bail out the banks in 2022? Why did they do all these things that were ultimately inflationary if the point of all this rapid rate increase was about curing inflation? And they're still not out of the woods yet. They think they've made progress. Well, progress doesn't get us back to gas prices being where it was, food prices being back where it was. Progress means they're just going to slow the pace of future increases. We are stuck unless we start to see major crush in demand. But that means what? That means real pain for those on Main Street. But the fact of the matter is, the rapid increase in interest rates without reducing the size of their balance sheet has created significant pain for the Main Street. It's created higher debt at higher interest rates. We're now at record amounts of revolving credit card debt, and record amount of delinquencies, right? And we're seeing it before our eyes. People are being hurt and stung, and they've had to take on debt in order to just maintain the standard of living. Yes, they're going to cut rates, but who's going to be there to borrow when you're loaded with debt unless what? That debt gets written off. So again, we're staring right now at this precipice. Where is interest rate going? ZIRP is down here. We're pricing in 2.75 right here by the end of next year. The fact of the matter is this may overshoot. So what are the signs this week? The signs are looking at 10-year Treasury and 30-year Treasury yields, right? By looking at this, we can say, okay, yeah, we're broken down. We're 3.6%. Do Treasury bond notes and bonds, do they find a bid? IEF kind of represents an ETF that kind of represents that 7 to 10. Do yields fall and prices rise on 7 to 10-year Treasury yields, Treasury note prices? TLT, this is your 20 to 30-year Treasury bonds. Do we see a breakout here, or do we see selling? At the end of the day, if the Fed wants to improve the lending ability of banks, assuming there's anyone left to lend to that can afford to borrow money and service their debt, what they want to see is this CGI. So with TNX again, we'll draw a correlation here between minus $ IRX. Sorry, it's not dollar sign. Jeez, IRX CGI. And I want to take off these study in here, right? Remove all studies. And let's go back here a ways. Let's go max available. Okay. So the train is leaving the station. Where is our destination? Well, normally when you have an inverted yield curve, when you start to see us normalize that yield curve, you're in recession, right? Back here, 97, 98. Well, you could argue we should have gone to recession. We had the Asian financial crisis, long-term capital management. The Fed went crazy in terms of what? Printing money. Okay. They kind of pushed off and pushed aside the U.S. recessionary pressures. 2000, they weren't able to do that. 2006, 7, 8, they weren't able to do that. As they cut rates, and initially long-term yields were falling as they were cutting rates. And again, we're seeing that TNX chasing down with IRX and eventually starting to take hold by when? Reaching a difference close to 4%, similar to 2001 and 2003. By when? October of 2008. That's post-Lehman, isn't it? Okay. We engaged in Operation Twist, trying to create inflation, right? We saw this was successful for a little bit to steepen the yield curve and getting to a 3% difference between 3-month treasuries and 10-year treasury notes, bills and notes. Back here, we hit inverted yield curve 2019. Again, the Fed lower rates to ZIRP initially, right? It's big rangy candle there. Did not move. Long-term rates collapsed because we're entering recession in 2020. Again, they cut rates to ZIRP, put $5 trillion in the system in order to create what? A difference of about 2.5% between the 10-year and the 3-month T-bill. And by as soon as they began to really look at raising rates, by February, April, talk about raising rates, they began to raise rates in 2022. the yield curve became inverted. Of course, the Treasury policy last November certainly kept this in kind of a restrained environment. Okay. Because again, they've issued a lot of short-term debt, keeping short-term positive rates instead of let this creep back above. This is going to get there, right? If the Fed keeps cutting, which it looks like that's what their intent to do, we're going to see this back above. There's a 1%, 1.1% difference. We're going to see this back above. It's just a matter of how long is it going to take? If long-term treasuries sell off, it won't take as many rate cuts to get us back there, right? Back to 2.5% or 4%. Problem is, the Fed funds rates at 5.25%, 5.5%. The 10-year's at 3.6%. How much is the 10-year going to have to go up to get to a 4% difference? Well, if the Fed goes to ZERP and the 10-year Treasury yields go to 4%, now we have a 4% difference. If 10-year Treasury yields go to 6% and the Fed funds rates at 2%, now we have a 4% difference. We're still talking about a relatively low interest rates. So the Fed is going to have to keep cutting. So we look at next year, 2.5%. Okay, that means what? 6.5% on the 10-year Treasury yield. That's going to be very, very problematic for Main Street if that happens. The issue is this. They're not likely going to be able to stop early. They're probably going to have to stop late at zero interest rate policy. And who knows? They may progress with the inanity and go to negative interest rate policy. What does that mean? Negative interest rates. It says that we're wired to say, give me $10,000 today, and in a year, I'll give you $9,900. Nobody goes along with that, right? Nobody believes in that. Debtors sure appreciate it because they might get a mortgage at negative interest rates. Okay, great. We've already been told by other countries that have pursued this policy, namely Denmark and Sweden, that it doesn't work, but it doesn't matter. This is not about creating rational policy. You put 12 people in a room with huge, tremendous influences around them. They're not about creating rational policy. They're about the policy of expediency. And as a result, we're dealt with irrational policy, and we're expected to make rational decisions. And when we make rational decisions, meaning borrowing and spending, and we lead to crises, then we're told we're irrational, we're not making good choices. But then we want to save and get away from that system. They say that what? It's the paradox of thrift, saying if you save money, you're going to kill people, right? You're hurting the economy by saving money. And so we're going to lower interest rates to zero interest rate policy in order to get you to save less money. And right now, the savings rate is the lowest it's been almost ever, right? The amount of savings we have is low. The amount of debt that we have is extraordinarily high, and we're not able to service. And we've seen a lot of companies give some warning signs, right? Ally Bank, for example, no, it's ALLY. Ally Bank, big drop last week. Why? Auto loans, right? What happens when they have to confiscate your furnace? All this stuff that they invest in terms of the debt and financing these purchases, right? Capital One Financial. This is yet to get hit. It's a domino that's likely going to fall. JP Morgan last week got hit, right? Now, again, this may continue, but again, we're talking about a Fed cut this week. What is the market's response? What does gold do? What do financials do? We have all these various sectors and asset classes that are poised to move. The question is, what direction? The train is leaving the station on rate cuts. What is the final destination? The reality is the final destination is already known. It's going to be a crash, right? It's a train wreck in the making. The only question is whether we first go through inflation town, whether we go through deflation town or stagflation town. The bond market should give you a clue. Gold prices should give you a clue. Gold prices broke out last week, almost reaching our target of $240 on GLD. The dollar sold off hard. Is this a case of buy the rumor, sell the news? We've been building to this climax of Fed rate cuts, and now we're poised to see the selling. As I look at the market here and you study market cycles, This is a V-shaped bottom right here, right? This is not easily achieved. It normally occurs as cycles come together. Short-term, intermediate term, long-term cycles all come about. And as we look at the rally off this level, yes, we're leading to this big move here. But then we get this pullback. And now we're seeing the move. Maybe a 3/4 cycle high, maybe form a higher high, maybe form an equal high. We don't know. But what we're likely going to see is that long-term cycle begin to roll over. And then it's a matter of how far do we go? Do we only go back to 5,100? Do we stop short of 5,400? Or do we maybe just bounce back, test 56 and reject and go higher? We still have plenty of time that we need to see in order to work all this stuff out to know our destination. But there will be road signs this week by looking at financials, by looking at gold, and by looking at the bond market. And then we'll see whether we can carry it through to next week. Maybe the surge is very temporary on the news, and then we sell off. Okay? So again, all we're looking for is signs. We're leaving the station, we bought a ticket, and we don't know where it's going. Look for signs, as it will give you an indication early and then late, and then eventually we'll reach our destination. We look back in hindsight and say, what? We know where we went. But at this stage, leading to Wednesday, the point is be cautious. Be hedged. Have cash available. Be ready to buy a ticket to ride it if the destination is the one you want to ride. And you want to get long or you want to get short. You want to get long gold, want to get long financials. There's a decent chance here that things work out well, at least in the near term. We're seeing it today. The leading sector today being financials. This could create a decent opportunity to buy an upside call spread. Sell some calls on the S&P. It's called a catapult. It's one of the strategies we teach here at TheoTrade. The Don Kaufman developed, right? The dispersion trade may favor financials in this circumstance if things work out bullishly, because we're trying to march short-term yields lower and hopefully long-term yields start to reflect positively, creating a positive net interest margin and hopefully leading to more lending and net interest income, and may help financial stocks, at least in the short term, before defaults start to roll in. You can buy call spreads and sell calls on the S&P, the MES, to finance call spreads in XLF. These are stuff that we teach here at TheoTrade. Okay? So there's lots of things we're kind of waiting for. Unfortunately, it's 2 days out. We'll see the progression. Again, we're looking at the volatility markets now. The VIX was actually up slightly today, but basically flat on the session. We'll see whether we march higher into this, expecting more movement. Very likely can happen. We'll look at skew. Skew is at 149. We'll see whether we tick higher or lower today. We ramped up into last week to about 163. We saw some selling. It came back down. Now we're coming right back up again, aren't we? Okay, we look at the VIX, 3M plus fixed ratio. Oops. What's the forward expectation of volatility as the VIX comes down? Normally you see the expectations of volatility ramp up. Of course, the VIX rose today. We're looking for this yellow line to get back above 1.2 again. If we see a bid tomorrow and the VIX declines, or post-Fed, the market goes higher, the VIX declines, this could really pop up here north of 1.2 again. And that gives us another bearish signal, right? Watch out for the downside. All right, so we got a lot of stuff to watch. We just don't have a lot of information. All we know is the Fed is leaving the station on rate cuts. Destination unknown. Folks, we'll catch you back